Let's talk about on a buy and hold, right? So you have costs there. And so a lot of people don't know the rule of thumb for those costs. What should those be?
So my rule of thumb here locally in Northwest Arkansas, if I'm buying a property that's, I would say up to probably 15 years old or less, or newer, I guess, 10% for capex, and this is of the rental. So if your rental income is $2,000 a month, you're going to take 10% of this and put it aside for capex or capital expenditures, 5% for repairs, 5% for vacancies, and then 10% for property management. Those are just rough rules of thumb. So off the top, you already need to take 30%. But planning on that 30% is a really good, safe measure to make sure you're actually calculating a good cash flow dollar amount or a cash on cash return from an investor standpoint.
Welcome to another REI-NWA podcast. This is episode number 59, and we have a repeat guest here with us. This is Darrel Donohew, and man, it's so good to have you back on the show. How you been?
I've been good, Collie. Thank you so much for having me. Glad to be here.
Yeah. So last time we talked about finding deals. This was episode 48 for those of you that may be curious. Go back and check that one out. There's a ton of good information in there. In this one, we're going to talk about running the numbers for your investment properties, making sure you're getting a good deal, because it's not when you sell that you make the money. It's when is it?
When you buy, every time.
It's when you buy that you make the money, right? So we have to buy smart. So Darrel is an absolute pro at this, an investor, a realtor at Weichert here locally, and an Army veteran. Thanks for your service, my friend.
Thank you.
Yeah, man. So let's talk a little bit about running these numbers. And there's so many different ways of investing, so many different people that, are considered real estate investors. But for this conversation, I guess let's narrow it down to if we're buying to hold for cash flow. So we'll talk through that. And we may get into, if we're buying to, fix, flip, and resell as well. So, but if we're buying for cash flow, what are some of the major considerations we need to take into account, man?
Yeah, of course. So I think the baseline is generally going to be your principal, interest, taxes, insurance, and then you have four major expenses to always calculate into that, Collie. That a lot of people will try to take out and say that you have cash flow, but you have to factor in your capex, repairs, property management, and vacancies. You have to have a team of pros like Collie on your team or a good contractor who can give you those numbers more accurately. So capex, repairs, you're probably going to need a good contractor. For vacancies, you're probably going to want a good real estate agent or real estate pro like Collie to tell you what the vacancies are in your region and in your area. A common mistake I see is that people will actually project out lower vacancy rates or lower capex numbers or lower repair numbers than what the market average is or what the property actually needs. So buying new, you might be able to get away with a few years of low capex, a dollar amount that you're putting away. But if you're buying a house, 10 years or older, you're going to have things that are going to happen from a capex perspective. So from a long-term cash flow, long-term rental cash flow perspective, I do think that a lot of people just leave those numbers out and they don't use them. And Wesley Fikes and I have talked about this pretty extensively, that a lot of people will try to say you have cash flow and sell you on a deal when you don't have cash flow. So I will be adding a spreadsheet, kind of a list of everything that I'm looking at the day that we do this meeting, from not only this perspective, but also from the flipping perspective.
Oh, okay. Yeah. So definitely make sure that you guys are coming out to this rookie nook. It's actually going to be on March 27th, coming up here in March 27th, 2025. And it's going to be, is this one going to be back at Whole Hog? I don't know.
I think it's
We'll see.
Big Whiskey.
Is it Big Whiskey? I'm not sure. Okay.
Yeah.
So anyway, Also, make sure that you are on the REI-NWA email list so that you actually get updated, uh, all the updated information of exactly where to go for each of our meetings as well. But yes, you definitely want to come out to get this supplemental information that Darrel's going to provide. So he's going to have some handouts and some different things that you'll be able to get at the in-person meeting. So make sure to show up for that. Okay, so are there some maybe rules of thumb on these different amounts that people need to take into account?
Yeah, definitely. There's a lot of rule of thumbs out there, guys. So the two that I really use the most are when I buy, I do try to buy at 60% of as is value. So if I bought it today for $100,000, could I turn around and sell it for $60,000? I do look for that strong or high equity position because I'm conservative, definitely more of a conservative investor, less risk adverse. So with that being said, that is the first rule of thumb, and that's my buy box or buy criteria. And then on the back end, if I'm flipping a property, I will not spend more than 70%. I will go up to 70% of the after repair value or the ARV. Again, you got to have a really good real estate pro in your back pocket, like Holly or someone else, that can tell you what that ARV is going to be. Every single little pocket in Northwest Arkansas is a little different. And cost per square foot on a sales price is going to vary from 4 different parts of Rogers, 4 different parts of Springdale, probably 10 different parts of Bentonville, right? So knowing what the ARV is really important. And then you are not going to spend more than 70% of that in your hard cost. So that's the dollar amount that it takes you to flip the property with materials and labor, your soft cost, and then your purchase price. So you can back into what your purchase price can be based on your hard cost and soft cost. So, for example, if you had a $200,000 house, you wouldn't want to spend more than $140,000 on your hard cost, soft cost, and purchase price. So, if it took you $40,000 to repair it, $40,000 to hold on to it, you would then have $60,000 left to purchase the property. Those are kind of a rough outline or rough rules of thumbs that I use and that I think that every person should use. And of course, I will have a spreadsheet the day that we do the presentation with things that you need to make sure you check off your checklist. Common things that people forget are insurance, interest, lawn care, utilities, a lot of things in that soft cost bucket. A lot of times people forget.
Yeah, and that's like during your holding period. Is that what you're talking about? Those some of those
Correct.
costs.
Yeah, and then a real estate pro can help you with that, right? If you are selling a house that's $250,000 or less, you could probably sell it in 3 to 6 months, right? If you're selling a house that's 500,000 or more, it might take you 10 to 14 months to sell that property, right? And so your soft cost or your holding costs will vary based on the price point that you're selling at too. So again, having a real estate pro, can't say it enough or stress it enough, but having those people around you to give you that information is half the battle, and that's where you win or lose.
Yep, yep. It's always great to have a professional that has direct access into that portal, that MLS, and they can pull all those stats and they can provide those to you. I highly recommend that as well. Okay, so let's talk about on a buy and hold, right? So you have costs there, like you were talking about when you were talking with Wes, um, how people don't calculate those, and so a lot of people don't know the rule of thumb for those costs. What should those be?
So my rule of thumb here locally in Northwest Arkansas, if I'm buying a property that's I would say up to probably 15 years old or less or newer, I guess, 10% for capex, and this is of the rental. So if your rental income is $2,000 a month, you're going to take 10% of this and put it aside for capex or capital expenditures. 5% for repairs, 5% for vacancies, and then 10% for property management. Those are just rough rules of thumb. So off the top, you already need to take 30% off the rental income. So your $2,000, right? 30% of that is $600. So you want to put $600 aside for those expenses, and or your property manager might take your 10% every month from you automatically. But planning on that 30% is a really good, safe measure to make sure you're actually calculating a good cash flow dollar amount or a cash on cash return from an investor standpoint.
Yeah, that makes a lot of sense. And if you're just calculating this off of your principal, interest, taxes, and insurance, you may be over that 70% that you need on a monthly basis. So you really got to watch those numbers. And yeah, we've seen it be difficult for people to buy at a price point that a seller's willing to. The sellers and the buyers right now are not always matching up in a way that allows those buyers to rent at a good cash flow. What about flipping to rent?
I really like flipping to rent. I think that's probably the best opportunity in the market today. And again, my rule of thumb is always 60% of as is value. And then the goal is to any sort of renovation that I add, it's dollar for dollar. Well, usually a dollar to dollar for value versus what I'm putting into it. And that does allow you a large equity position with much less cash out of your pocket. And you're more likely to get a DSCR loan, which is a debt service coverage ratio loan, or any other loan that's for a rental property. But when it comes to investors, Coley, I think a lot of times people just look at the cash on cash return or cash flow every month. But in this market, I truly do believe that it still can be a wise decision to not make cash flow. Even if you bought a property and flipped it and you were at a 60% value to equity position, so if you have 40% of equity in that property, you still have other ways to make money. As we all know in real estate, appreciation, equity buildup, and then the depreciation or tax benefits. But in this market, I really do believe that looking at all those factors is really important. So I will buy a property if I have a 40% equity position on the front end. I'm okay with just keeping that equity in the property and breaking even every month because I'm looking at it from a long-term perspective. In 10 years, how much value or equity will I have in that property? And that gets a little bit more complex, but you can calculate an IRR or internal rate of return when you factor in the appreciation, tax benefits, equity buildup, things of that nature to really see what your return is going to be.
Yeah, I think that makes a lot of sense. Yeah, you've got to do those calculations to see if that makes sense for you and your particular risk appetite as well. So, because what if prices go down and then you're stuck there, and what if rent rates go down too, right?
Yeah.
So make sure that you do have the appetite for that risk and the ability to weather it if necessary. So,
Yeah.
and that could be savings, it could be equity that you've got in other properties. Just make sure you've got some padding there if you're going to deploy a strategy like that. But the upside could be tremendous from just having that property. Even if there was a dip at some point in the future, within 5 years, you're usually through it. So
Yeah. There's too
yeah,
many
if you can
guys
weather
in,
it, you're fine.
yeah, 2008, I think there was too many guys that, or gals that failed. And I've heard advice from a few of the older generations of contractors and developers, and they've all told me, do not think that you're invincible or that you're smarter than the market, right?
Yeah.
And so if you can, people who've lost it all. And so having a 40% equity position, if the market drops 40% tomorrow, you're still in a position where you're not losing money per se,
There you
right?
go. Yep.
And you don't truly lose until you sell. And another rule of thumb is to make sure that you do have, it's no different than your personal emergency savings, right? Having 6 months or 3 to 6 months of living expenses, right? Have 3 to 6 months of living expenses for your rentals, right? And treat it like a business. And you do have to have that property reserve and ensure that you can weather the storm.
Yep.
And I know it's kind of counterintuitive, and a lot of people, it's hard to comprehend at first. But the more properties that you have, the safer you are. All right, and it's kind of a tough thing to realize. But when you have 1 to 5 units, it is way tougher to weather a storm or weather even a vacancy. Right, someone's not in one of your units. So when you can grow, that's one good reason to grow a portfolio or have multiple units for that reason, is you can weather more storms. Not to say it's right for everybody, but I do think that having that rule of thumb of 3 to 6 months of carrying cost, so your PITI at the minimum for those properties is important. So don't get ahead of yourself and buy right.
Yeah. All right. Well, this has been a value packed last 15 minutes, man. This
Yeah,
is really good. Actually, there's a lot here that I think people can take away from this. So yeah, take those notes and really think about how you want to implement this into your investing and into your strategies, and look for any vulnerabilities that you might have with these things. Right. So maybe you're doing 80% of it, but oh yeah, there's this one cost that I'm not thinking about, or this one place where I am vulnerable, right? So really look through those things, and then of course apply these to your next acquisition. If you haven't been doing it right, make sure that on the next one you do knock it out of the park and get that grand slam deal. So definitely come on out to our rookie nook. That's going to be coming up on March 27th, 2025 with Darrel. Get the supplemental information. I'm excited to get my hands on that as well, man, to see your full list of line items and things people need to be looking at. And so any final thoughts there?
Nope. I think that I can sum it up with a quote, but yeah, people without a vision have no hope. So your vision can be exactly this, right? Create your buy box, create your rules of thumbs, and stick to it, right? That is your vision. And then Coley and I were talking before the show, but measure outcomes, or excuse me, measure actions, not outcomes. I think Stuart Collier actually kind of talks about that a lot too. But yeah, measure your actions, not your outcomes. The outcomes will come. So,
Yeah.
but find the actions that will get you the outcomes. And there's a lot of smart people out there like Coley Bailey and Stuart Collier who can, with a lot of free information, and you can swing by our Rookie Nook and get some free information there too. So gather it all in, soak it in, and live it and breathe it. And that's all I got. Yeah.
Absolutely. Yeah. Uh, I love the quote that no deal is better than a bad deal. So just not
Oh,
doing a
yeah.
deal is better than doing a bad deal.
100%.
So if it jumps outside your buy box, you got to kill it,
Yeah.
you know?
Yeah.
So, all right. Well, that's it for this episode. Thanks for joining us. We'll see you at the Rookie Nook.
See
Thanks,
ya.
Darrel.
Thank you. Bye.
See you, man.